Hello, everyone, and welcome to my YouTube channel. I am Zachary Ireland, real estate investor and real estate agent here in Sudbury, Ontario, a great booming, exploding in population and in GDP, primary resource-based market in northern Canada. It's about 3 hours north by car from markets like Toronto. Most people in the world have heard of Toronto in southern Canada near the US border. So today's video is pretty interesting. It might go a little bit long. I am kind of under the gun because I'm watching a baby monitor as I record today's video. So we'll see how long and how far into the script I get. It could end up being quite long. So do stick around until the end if you're interested in the topic. I don't clickbait the titles of my videos. I just try and make them as simple and, easy to understand, because I understand that people like me are in a rush. They have kids, jobs, they don't want to be watching 2 hours of content to get no value out of it. So I do try and cram as much value as I can. And already I'm out of breath because I'm talking faster than my lungs can keep up. So today's video is all about, what real estate agents won't tell you, or what mortgage brokers or whatever investment professionals won't tell you about, the important background of real estate investing, and that is the macroeconomic factors of the market in which you're investing. The reason I decided to do a video about this is I was, brushing up on some of my fundamentals, as I like to do, learning, some first and second year university level stuff, reviewing some of the textbooks that I got when I was doing my undergrad in finance and business, and, I really kind of stuck on this idea of private equity, hedge funds, and going over securities and different kinds of equities in companies and real estate investment trusts and how these things all play together. And the first step when you're investing in stocks, or you're investing in foreign exchange or ETFs or whatever it may be, whatever asset class you're investing in, or something like real estate, which is considered an alternative investment, the first thing that you would look at is kind of the big stuff, the large factor, the large market, market level decisions. And these are typically called macroeconomic factors. So economics, Greek term, came from Greek, essentially means household management. We kind of have used that term, grandfathered it in as an understanding of decision making of human beings. Macroeconomics refers to large scale, like countrywide decision making. So what, an entire country's economy would consist of, or the entire world for that matter. And I broke it down into six factors to consider when you're thinking about investing in real estate. And these have nothing to do with the specific property that you're going to invest in. They have everything to do with the market that you're going to be diving into. And kind of the analogy that I thought of, if you're bringing this up to colleagues or even your real estate investment helpers like brokers or whatever, when you're bringing it up to them, make sure that they understand that you're being very careful with, the market itself that you're investing in, not necessarily the specific assets, because there can always be mistakes. Adverse selection is a huge, obstacle to climb over. And especially in the beginning, you want to be making good decisions on what assets you buy, like which, for instance, do you buy house A or do you buy house B? But this video is all about, do you buy in that city at all? And that's kind of what you'll learn if you stick it around to the end. So I want to open with an analogy. Like I said, imagine your friend, you're watching the Olympics with your friend, and you both decide that you're going to bet on swimmers in the Olympics, but you decide to come up with a different game. So he says, which swimmer do you think is going to win the game, A, B, or C? And you say, would you be willing to make a different bet? Would you bet that this pool of swimmers, the Olympics that you're watching, let's say the men's swimmers, would you bet that the men's swimmers are going to swim faster on average than the women's swimmers on average? Like, which one would you want to take? And without going too much in the gender differences, it's pretty obvious that you would pick the pool with higher average swimmers. That's a much better bet to make, rather than just choosing individual swimmers, spending all of your time, analyzing the muscle mass, the height, the wingspan of all these swimmers. These things are susceptible to a great degree of randomness. And of course, on a market level, you are as well. But if you focus more on these big factors, these large scale things, and base your career on making macroeconomic decisions first, and then after you've made good, sound fundamental analysis, then being confident and making good individual choices on which properties to buy later down the road. But of course, that comes afterwards. What you're told initially is come see some properties, and they just want to put the pressure on you so that you buy something quickly so they can make a commission. But I don't believe in that philosophy. So the first thing when deciding on which markets to invest in, or if to invest at all, would be the current interest rate scenario, or the current interest rate environment, we'll say. So recently in March 2023, when I'm recording this, the Bank of Canada announced for the first time in over a year that they would not be hiking the interest rate, the overnight rate that they lend to commercial banks. So this is key. This is very, very important because for the first time in over a year, it seems like the Bank of Canada is saying, we've done enough. We're just going to sit where we are, essentially waving the white flag to the market and saying, you guys are doing what we expected you to do, so we're just going to ride it out. And the reason, obviously, that interest rates are coming up is because of inflation. Inflation is very, very bad for economies like Canada, where stability is a lot more preferable to instability. Especially a market like Sudbury actually benefits from inflation, like it or not, because of equities. Because of commodities, I meant to say. So because Sudbury is a primary resource sector, relies heavily on the primary resource sector, things like nickel, forestry, and even the secondary factor, like we have the secondary markets. We have factories, we have lots of industrial property and people, creating things in Sudbury. You might not believe it, but things are actually still created in North America, and Sudbury is a really important place for that. Sudbury actually benefits in a bunch of ways from inflation. We won't go too much into that because this video is not about Sudbury itself, but it's just to give an example, to give how I look at macroeconomic factors and try and apply them to my own market to decide whether, my own market is still worth investing in. Because if it wasn't, I might just pack up and move. It might be time to move on or start investing somewhere else, living still in the Sudbury market. Because obviously if you run a real estate business, doesn't matter so much if the market's going up or down, you still make money, which I made a video about running a real estate business. You can find that on the channel. So when interest rates are low, I have in my notes, it can be easier and more affordable for individuals to purchase a property because mortgage payments will be lower. So obviously the reason interest rates matter is because most real estate for most of history has been bought on credit. So when credit becomes more expensive, when interest rates go up, that's what interest rates are, credit rates. When interest rates go up, mortgages become more expensive. That means real estate investments make less sense. Now, why do they make less sense? Because we buy them on credit typically. That's what a mortgage is. It's a credit secured by property or a loan secured by property. Whereas in something like equities, something like stocks, while the company may have debt on its balance, and stocks might go down when interest rates go up, that's true. Stocks are not, usually bought on margin. So individual investors typically don't buy, stocks on 5 times leverage like you might a multifamily property, or even 20 times leverage if you're just buying a single family or a duplex home. 20 times leverage is pretty high. If you're locked in for 5 years at a fixed rate mortgage, you're protected to a degree. Maybe I'll just go over that quickly. So when you do buy a property, you decide it's the right one. Fixing or not fixing, like getting a variable rate mortgage, is going to be a decision you have to come to between you and your mortgage broker. And it's an important decision, but I would say it's not really worth the fuss that people put into it. I'd say in almost all scenarios, it's better to get a variable rate. If you have the money to invest in real estate remotely with like 20-25% down, like I said, you're probably, not pinching pennies, and variable rate mortgages in almost all scenarios are cheaper in the long run. So a 5-year fixed rate mortgage will save you money if interest rates go up like they have recently. But if you're able to call interest rates in advance like that, if you're able to say, I think interest rates are going to go up, several points in the next 2 years, and then I'm going to ride out my 5-year fixed mortgage and make a ton of money between that interest rate differential is what we call, or credit spread, the difference between two fixed incomes. fixed income interest rates. Like if you can make a prediction like that, maybe you shouldn't be in real estate. You should be in, equities trading. You should be trading bonds, because if you had shorted, even if you couldn't necessarily pick a specific bond, if you shorted bond ETFs in 2022, expecting inflation and interest rates to be going, if you're smart enough and if you made a prediction like that, you would have made a lot more money in bonds probably than in real estate. And that's kind of made in tongue in cheek. But the point is, if you can predict the future, maybe real estate isn't for you. Like real estate is for us down to earth, normal people that aren't Superman, that don't have secret, X-ray vision that can see through walls and buildings and have insider information. Real estate's for down to earth people that just want a solid, long-term, good investment that makes a solid, really good return, and you can leverage it. So if you can predict the future, again, maybe you should use that knowledge to your advantage in something like bond markets, high yield or low yield markets. And, you can learn more about that on other YouTube channels. That's not what I talk about on my channel. I think, you should just go with a variable rate in almost all scenarios. If you're really, really strapped for cash, let's say, like I know many people when they buy their first property, they'll buy it for 5 or 10% down because that's all that they have for a down payment. They'll live in the property themselves. I would suggest for most average normal people to actually fix their mortgage in that scenario, unless the mortgage is just at a ridiculously high rate. And maybe even in that scenario as well, because the risk of it going higher and you losing your down payment, losing your house, is just too great. And I think fixing your mortgage at a rate that you can afford is usually a smart idea for people that can't, necessarily bite the bullet if rates do go up. And when rates go up, as we've observed in the last couple of years, prices in real estate tend to stagnate or go down. And that's simply because the low interest rate environment before that, this caused a boom. So after that boom, everybody knows the term, what goes up must come down. It's not necessarily true. What goes up, must eventually become rational is what I would say. Sometimes that rationality means it crashes. In this scenario, it looks like that rationality is going to be a stagnation for a couple of years, which if you talk to educated people, again, I'm not making some crazy prediction. I just looked at the data for the last 40 years in the Sudbury market using, real estate board sales data that I have access to. If you'd like it, reach out to me in the description of the video. But looking at that data, I pretty much predicted that there would be a stagnation after 2020 and 2021. Still think it's great to invest, by the way, because the returns are stronger than ever. So the second factor going into it would be predicting economic growth. And again, we don't need to really predict these things. We just have to look at the numbers as they exist right now. The overall health of the economy is something you want to consider when you're investing in a macro environment. Like, let's say I'm split and torn between investing in Ontario real estate and investing in, let's say, New Brunswick, Canada real estate, a smaller province, even more reliant on primary resources and forestry than Sudbury is, or Toronto, for instance, is. But I'm really considering the two, and which one should I go for? If you ask me, this factor alone would exclude New Brunswick as a possible investment opportunity because it just does not have the economic growth. Where would you find this data? The census. So the census in Canada is a really, really good resource. I'm going to go over this at the end of the video if I have time, of all the things that the census can tell you about macroeconomic data, and it's probably the single most important thing you should be looking at. The great thing about the census is you can compare things like province to province. You can look at GDP growth, province to province. You can look at industry breakdown, province to province, and you can look at over time, you can plot the industry growth or shrinkage, of industries, population, GDP. And New Brunswick generally is a sinking population, and it's a sinking GDP or stagnating. So a weak economy is going to create weak demand for real estate. This is absolutely true. So I'm not hating on New Brunswick, but it's just kind of an easy punching bag because it's so common that people will compare a market like Sudbury to a market like that and say, why don't I invest here? I can get an 11% return net operating income in New Brunswick. In that case, I'd say, if that's the only thing that's important to you is that number, then maybe it is better to go to New Brunswick. You can wipe your tears on all the money you lose with that 4% interest rate differential in New Brunswick. I personally would never do that. Investing in a sinking ship, as it were, is just, to go back to the water analogy with the pools, it's just not a good look. Like, for instance, there was a race. You're watching a race with two swimmers, and one of them is significantly ahead of the other. Like, which one are you going to bet on? Honestly, you're going to bet on the one that's ahead. You're going to bet on the one that's ahead. There are underdog stories. They do happen. But they're so interesting because they're so rare. So, typically you're going to want to invest in the winner, and Ontario, Quebec, especially Ontario and British Columbia, are the clear winners in the Canadian real estate market. They've just proven that they have, they go the distance. And markets like Alberta are interesting for people like me as well. For another reason, we're going to go over in number 5 in government policies. But it's too reliant on certain industries, in my opinion. Being too reliant on the oil industry, which is historically a pretty volatile industry, is just not a position, a large capital investor would want to be in. I try and structure my investments in a way that, like, I could pitch them to all of my clients and feel comfortable doing it. I don't feel comfortable pitching investments in markets like Calgary and Edmonton, which are very heavily reliant on oil. They're essentially oil derivatives. They're real estate markets, meaning what oil does, those markets do. Again, if you're very, very good at predicting what's going to happen in the oil market without insider information, maybe you should be trading oil futures, commodities rather than real estate, because these are only ancillary figures to oil itself. There are lots of other things, but it is a principal part of their real estate market. I already alluded to this before, but inflation is really, really important when you're deciding where to invest. Sudbury, like I said, it's kind of benefited from inflation in some way. Perhaps benefited is not the right term, but it's been floated above inflation because we're heavily reliant on commodities, and commodities have done so well in an inflationary environment. They typically do. So you've probably, been to the grocery store in the last year. You notice that food has become much more expensive. Wouldn't you expect places that create food to be doing better? Absolutely, you would. Companies are raking in, record profits, across the board. So where the companies are making those record profits, the employees are going to be making record wages, blah, blah, blah. You know the rest. Go where the money is. The money is moving into commodities, which I'm going to go into, I guess I can go into right now. So a big part of the Sudbury economy, for example, and when you're researching your macro economic data for your markets can be different, but Sudbury's market is heavily reliant on precious metals. And precious metals have come into the news lately because of the EV electric vehicle boom. So the electric vehicle market has exploded in the last decade. Obviously, people like Elon Musk and governments around the world have said we need more precious metals. There just aren't enough being extracted. It's causing bottlenecks in production lines. And who would you really rather have, extracting precious metals from the ground? Places like, war-torn Africa or Canada, like, a rinky-dink town, 160,000 people in northern Canada called Sudbury, or Russia. Those essentially are your three choices. I think you would almost always go with the safe option, which is Canada. So since, World War II and before, Sudbury has been an amazing source of precious metals, especially nickel, which is a primary ingredient, you could say, or input into EV batteries. So when looking at things like that, what is the market dependent on? Think of the future. Think of, okay, this is a growing sector. EVs are growing, explosively. They have been for the last 10 years. Like I said, pretty good bet that precious metals and commodities are good to be in. And when you see inflation like you have, it just kind of bolsters that hypothesis even more and say, okay, seeing that the Sudbury market is holding up a lot better than places like Toronto, which doesn't have as much of a primary resource focus, maybe, this is a proof to my hypothesis that Sudbury is a good long-term real estate investment. Obviously, inflation is the cost of goods and services going up. Real estate agents and mortgage brokers and stuff, we actually really like inflation, and I'm going to tell you why. It's because real estate generally inflates faster than other goods and services. at least in Canada, because of population growth. So I kind of talked about this before. I'm going to go into it more in number 4, which is demographics. But when a population increases, the demand for real estate will also increase. They usually move, in lockstep. So as as population increases, demand for real estate goes up at the same or a faster rate. And what that means is real estate agents are making more sales, per agent or per mortgage broker. They're making more sales for higher prices because when prices go up, their commissions will go up. Now, there is a controlling, efficiency to the market in that as prices go up, typically realtors will bump down their commissions as a percentage of sales. They'll say to their clients, that guy's charging 2.5%. I'm only going to charge 2%, so you should go with me. So there is kind of a control on it, but like I said, the two kind of do go together. Commissions and prices of real estate go together. Inflation and real estate go together. Real estate agents and mortgage brokers have done pretty well over the past few years with inflation as it has been. The problem with inflation, in my opinion, is it hurts individual families. And when you're talking about residential rental real estate, which is what I personally focus on and a lot of my clients will focus on, the problem with inflation is that it makes residential real estate unaffordable on a percentage basis. So just without going too much into detail, what we look for and what I look for personally when renting to a client is, can they afford this based on their income? And the ratio that I use is the same as the mortgage industry, which is, 36% of, gross income to rent ratio or living expenses. But essentially it's rent because we do all-inclusive rents most of the time. So it would be, as long as the rent is only 33 or 35% of the person's income, they can more or less afford that rent payment. Now, in, mortgage, they care more about debts. So if you see a large credit card bill, if they see a large coming in every month, if they see a large car payment, they might bump down the amount of house that you can afford because of that. But in rentals, again, it's not as important. And the reason is I came to this conclusion as a consequence of reading Peter Lindman's real estate investment textbook on this. I think it's Risks and Opportunities. It's one of my favorite books. And basically what he says is, people will pay for their house before they pay for things like a car and a credit card because you need somewhere to live. And I generally agree with that. So if they have other debts, generally they're going to pay their rent first. And people in the comments, whatever, they're going to disagree with me. It's possible and say, well, Ontario, the laws and whatever aren't beneficial to landlords. That stuff is mostly mitigated by research beforehand, credit history. People with good credit, again, people with good credit are the ones who are ahead in the pool, that are racing faster. And those people generally will do better over time. So as long as you pick the winning people by using background checks, you can be pretty confident that inflation is not going to be a big deal for you personally. But it is something to consider when you're thinking of investing in a macro environment. We'll talk about demographics quickly. Demographics refer to things like population growth, age, income. That's how much productivity people are outputting. And I think demographics also applies to things like racial and cultural makeup. Though we don't talk as much about them, it is something important to consider. Just to give a very, very light example, lighthearted example, absolutely love what's been happening in Sudbury the last few years. We have many, many immigrants from around the world coming here. Immigrants are an interesting prospect for rental real estate because they don't have the credit history or necessarily the jobs, the full-time jobs to hold down a mortgage payment. So they will rent at least for a few years when they first get here. But people from different countries, especially like developing countries, developing places in the world, are willing to live at a lower standard than we in North America are. Like, just for example, I might be willing to live with a roommate in a 2-bedroom apartment. Each of us get 1 bedroom. We share the kitchen, bathroom, living room, such and such. But a lot of these students coming from places like West Africa, South Africa, even the West Indies, the Caribbean, the Indian subcontinent, these places, the Middle East, these people have, a lower expectation, which means it's weird to say, but they can get away with lower living standards, and they're okay with it. So to save money, they're paying so much money already in tuitions and living expenses compared to their home countries for food and things like this. They're willing to give up a little bit of comfort compared to what we would be as native-born Canadians. So that's a really interesting, part of real estate investing. It's part of the vetting process to ask, international students or, people that are on a work permit, how many people plan on living in the apartment. And sometimes they'll be upfront with you, and sometimes they won't. I've had this happen before where people from the southwest part of India will come, and it's interesting because it's actually this part of India, like the Kerala region of India, is generally Catholic. It's not as much. We might be more familiar in Canada and markets like Brampton and Toronto. They're more familiar with the Punjab region of India, which is more like the northern region of India. And obviously there's over 1 billion people in India. They have all different cultures. And anyways, back to the Kerala, they do have, a similar bent that they're willing to live more people to an apartment than necessarily we would. For instance, if I moved to India, I'd be willing to pay a little bit more for rent to have my privacy and have my own area. But when you flip these two, when they come to Canada, they were upfront and said, yeah, we're planning on living 8 of us in this apartment with just 2 bedrooms. So that's just an example, but it's something to consider in demographics. If a market is almost entirely native-born Canadians, like some of these very rural areas of Canada with no college, no university, no international students, that's something to consider. It definitely is. And these international students will expect a lower rent payment. They're not each going to pay the same, per room rental as, again, pardon my, frankness with this, but they're not going to pay the same as these native-born Canadians living 2 people to an apartment. You can't charge $700 per student, in a room to rent 1 room, and then you can't charge $700 per Indian or African student to live 8 to an apartment. It's just not going to happen. The reason they're giving up that comfort is to get a lower rent payment. So it's something to consider. The landlord might be able to, take small wins on this. But again, this isn't really about renting to specific people. This is more about macroeconomic factors. Hopefully, people don't get too heated about that. But I'm just saying things as I understand them and as I see them. Growing population we talked about, but this is a big part of demographics. So, for instance, in the census, as I mentioned before, if you look at Canadian, or it's the same, I presume, in many countries around the world that have advanced statistics on this. If you look at demographics, Canada in general is hovering around an average age of 50, which if you looked at the rental market, you would say that's a little bit old. Someone that's an average age of 50, a little bit less likely to be renting. Renting is typically something you do when you're younger, not always, but most of the time, and then you would end up buying a house as your income increased, you get married, etc., etc. Age 50 is a little bit older than the median age of a renter, and we have statistics on this. But it doesn't necessarily mean that those numbers are going to stay the same forever. So like I said, international students are making up a big portion of our real estate market now. And what that means is the average age is falling, which actually means the demand for rentals is increasing faster than the population is growing. Because the population is not growing commensurate with the average age. It's actually lowering the age as it goes. And this is, just one factor that you would need to consider is look at the average age of the area that you intend to invest in. And the great thing is about the Canadian census is you can actually break it down by age group. So for instance, like 18 to 29, you could see what percentage of the population of that city is in that age cohort. And that would give you a really good idea of, how many renters there are going to be. Very, very crude, basic, but it is a pretty decent way to look at the number of renters. And you'll find that this is also in the Canadian census data as how many renters versus homeowners there are. Comparing the 18 to 29-year-old age to homeownership is pretty interesting. And also comparing the over time, because the census is only taken every 5 years, comparing the 5-year changes in those two is pretty interesting as well. And as you look at the census data, use your analytical mind, you can find some pretty cool and pretty interesting macroeconomic data for you and your market as well. I'm going to speed it up a little bit. Government policies. So very simply, Sudbury has very high taxes, but the prices are much lower, apples to apples for the same property. Prices are much lower for properties than they are south of us in Toronto and places like that. So we're willing to pay a little bit more taxes. We make up for it in a higher rent payment, et cetera, et cetera. It's not that big of a deal. But government policies on a macro level also affect us. So in Ontario, the laws are pretty beneficial to tenants. They actually give quite a few benefits to renters that landlords don't have. So, many friends and people who formerly were working with other agents and things and have come to me since have expressed difficulty with tenants, or, tenants don't pay and they can't be evicted because there are certain grace periods given to tenants, maybe 6 months or a year sometimes, where a tenant won't pay any rent. But there's just such a backup in the courts that they might not get kicked out right away. Which, again, if you don't have a whole lot of spare cash, even if you fixed your mortgage for 5 years, you don't have a whole lot of spare cash, that rent not coming in, you might not be able to make your rent payments, which is why you have to qualify based on your own income when you're buying on 5% down. Pretty interesting stuff. Supply and demand is going to be affected by, like I said, renter laws. It's going to be affected by changes in leadership. So, for instance, we just elected a new mayor coming up who just entered office in 2023 in Sudbury. Really interested to see how our new mayor, Paul Lefebvre, who was an MP, member of parliament representing Sudbury formerly, I'm really interested to see how he, deals with things like homelessness and how that macroeconomic factor will affect the real estate market here. I think I have a pretty good handle on it. I could make an entire video about it. Might even be able to get an interview with him and put it on the channel. But these are all just guesses. Like, if I knew these things for sure, I would just be trading equities. I don't know these things for sure, so I use real estate as my main investment vehicle. Finally, number 6 kind of ties in with the first one we went over, which is interest rates. This one is availability of credit. So we actually, in the United States, just had 2 bank runs in less than a week. And a bank run, if you're not familiar, is when people want to withdraw their money from the bank, but because, the way banks are set up, based on deposits and lending, they can't necessarily pay out 100% of their deposits right away, because a lot of those deposits are tied up in things like bonds and in other loans like mortgages. So a bank run is a big problem for a bank, and the federal government only insures banks to a certain degree. They only insure deposits up to, I believe it's $100,000 per institution. So some people might lose a lot of money if they invested in places like Silicon Valley Bank, and I hope that's not the case, but it might turn out to be the case. And the other one, it's escaping me right now, but it's a very famous bank known for lending to, I believe it's Silvergate, and they're known for lending to members of the crypto investment community. So places like FDX were customers of Silvergate. So availability credit, what that has to do with bank runs and why I brought it up, is mortgages kind of come in and out of vogue with banks, totally aside from interest rates themselves. And if you want to get a handle on this, it's pretty interesting. Plot in, a Google Sheets or an Excel document, plot the rate hikes of the Bank of Canada versus what the prime lending rate by banks are. And you'll see that they don't necessarily move at the same rates. It's pretty interesting. If I just quickly Google what the prime mortgage rate is right now in Canada, it's currently at 6.7%, meaning like if you have great credit and the bank generally thinks you're a good customer, they're going to be lending at 6.7% in Canada. Whereas like I said, they just, for the first time in over a year, refused to raise the interest rate, the overnight rate from the Bank of Canada. The policy rate's only 4.5%. So banks are essentially charging a 2% interest rate differential. And that's how banks make money, is on this interest rate differential. That's also how, consequentially, real estate investors make money. If you've watched my other videos, you lend from the bank at 6.7%, which is the prime rate. You might make 11 or 12% net operating income on that property, and then you collect the difference, which is multiplied by your leverage ratio. Really, really cool. But that's just to show you that, these prime rates don't necessarily follow the policy rate the Bank of Canada sets. And these also they can move in different directions at times. So let's say the Bank of Canada has been raising rates at 1% per 6-week period, and then they lower it to 0.5%, which just happened a few months ago. You might see that the prime rate, instead of going up by 0.5%, actually decreases by a little bit. And the reason this might happen is because banks look at, which is exactly what I did, banks look at that rate hike of 0.5% as good news and lower their prime mortgage lending rate rather than raise it, because that good news outweighs the 0.5% policy rate hike, because they might have expected it to be 1% and they were setting their prime mortgage rates based on the expectation that rates would increase another percent. Hopefully that makes sense. If credit is tight, if money to lend is scarce for mortgages, if the rates are going to be higher. Again, the policy rate does have an effect as well, but it's not the only important thing. That is going to limit demand on real estate because, as we know very, very well, people buy real estate based on credit. It's very rare that people buy real estate cash. Your primary residence, that's a totally different thing. It's totally up to you how you want to pay for it, or, ongoing, you want to pay a mortgage payment or not. I would recommend you do and invest that principal in, value creating assets rather than saving the interest rate, because, like I said, real estate investors make their money in the interest rate differential. They don't make it by saving on, mortgage rates. So I'm going to give you a few resources before we end the video, and these should not take very long to go through. These are macroeconomic resources that I have found useful, and hopefully you also find useful. One of them is the non-farm payroll. So in the United States, this is really interesting. Employment, unemployment, these types of things, very interesting to look at. If unemployment is going down, the economy is generally getting better. Sentiment is increasing. Employers are taking on more employees to create more value, to create more profit. They feel like it's a good time to expand their business. Non-farm payroll is an interesting indicator. The other is vacancy rates. A little bit harder to get a grasp on this unless you're in the industry, which is why you might consider starting a real estate business yourself so you can have a grasp on vacancy rates. But vacancy rates in a place like Sudbury, very interesting. Generally, it's a leading indicator on where rent prices are going. If vacancy rates are very, very low, rents are typically going to be rising because those, tenants who absolutely need to get a place will compete by raising the price they're willing to pay to get those limited rentals. What services are available in your market? Now, again, it's a little bit harder to get a grasp on this, but using Google, places like Yellow Pages, you should be able to find a pretty good property manager in your market. If you can't, you might want to reconsider investing there. Unless it's unless it's a class of real estate that you don't need a manager for. Commercial real estate, for instance, you might not even need one. If if all maintenance is covered by the tenant, for instance, you don't really need a property manager. You just need like a real estate broker who's going to deal with leases and things like that. Is there demand for your product in the market you're planning on investing in? I see this all the time. People from, bigger markets, higher end markets, I would say, come to a working class town like Sudbury or like Timmins or like these smaller blue collar towns, and they expect to, build brand new buildings and charge premium rents. Well, you might do well, maybe, with people moving in or changes over time in demographics and things. But generally, I would say, you want to fall right in the middle of the distribution. You don't want to be going too high on the rental scale and charging very, very high rents. You don't want to go the other way either, charging very, very low rents for low-end real estate. You want to find yourself somewhere in the middle. The reason why there's a hump at the mean is because that's the one that's worked for the most people. Employment sites like Indeed are interesting. If you're an absolute, data mining nerd, not going to say if I am one way or the other, make your own decision. But if you are, places like Indeed can be interesting. So look at Indeed for what jobs are being posted and in what frequency they're being posted. It's pretty interesting. Let's say you're seeing lots of job postings for low-paying entry-level jobs. $15 an hour, $17 an hour is kind of like the baseline for fast food and things like that. If you do the math on that, working full-time, let's just do the math on that really quick. Working full-time at $17 an hour for an entire month, 40 hours a week, we're going to say roughly 4 weeks per month. It's roughly $2,700 per month a $17 per hour wage earner is going to get. So what would their rent payment be? What could they afford to pay in rent? Well, using our normal calculation, it's 33 to 36.7% of their gross income, which in this case would be about $900 per month. Obviously, they have to pay taxes on their gross earnings, but that's why we use gross earnings, because everyone's in a different tax bracket. But it's interesting to consider that $900 a month is roughly where a low income person, low meaning minimum wage, not necessarily applying morality to that. I'm just saying that's what people earn in the low end entry level jobs. They're sitting pretty much exactly at where a bachelor apartment rents right now in the Sudbury market. 3-4 years ago, minimum wage was $14, $15 an hour, or what entry-level jobs were going for was the minimum wage at the time, $14, $15 an hour, and you would find that bachelor apartments were commensurate with that roughly 33% of incomes to that wage as well. So it's pretty interesting how the two move together. You can use that little tidbit to your advantage moving forward. Look at what the jobs are on Indeed, do the math, multiply by 40 hours a week, full-time working, and then find what that person could afford in terms of rent. What that means is most people are going to have to rent with a roommate. It's a necessity, or they're going to they're going to use government programs, etc., to make up the difference. Another interesting, cool, metric to use to look at taxes for the market you're planning on investing in. I mentioned Sudbury. Sudbury has a really cool website where if you just Google Sudbury, Ontario tax calculator, you could find the taxes for almost any property in Sudbury at your fingertips. You don't need to make an account or anything like that. You just enter in the address. So using realtor.ca in tandem with this can be pretty interesting. Look at properties that are listed right now, look up their taxes, divide the taxes by the net operating incomes to see as a percentage if they are comparable between properties in Sudbury. Sometimes you get lucky. Sometimes the taxes you pay on a property are very low, and sometimes you get less lucky. You'll pay high taxes relative to the income, that the property is generating. It just depends on the property. So again, we're not talking about micro, but if you are comparing market to market, maybe take 30 properties, look at the taxes for them as a percentage, annual taxes as a percentage of the value of the property or the purchase price of the property. Compare those to taxes of a different market divided by the value of those properties. I use 30 because that's generally accepted in statistics to be like where a decent sized sample would be taken. Try and get the same type of property between markets as well, so you have a pretty standard apples to apples comparison. I know I overuse that phrase, but it's really important in statistics to use an apples to apples comparison to kind of see which one is paying higher taxes. Now, you probably shouldn't be swayed one way or the other, but for instance, if you're paying 2% of the gross annual, if you're paying 2% in gross property taxes in one property compared to the value of the properties in one market, and the other one it's only 1%, that's a 1% edge that you have investing in this other market that you didn't have in this other one here. And investors might not be aware of that. You might have just found yourself an edge, and that's somewhere you want to be funneling your capital to. Pretty interesting stuff. A piece of advice, use the census data. So go find it, mess around with the tools that you have at your disposal. They're completely free. The ones that I recommend first looking at are demographics, things like age, and ethnicity, even if that's something you want to look at. I know I kind of glossed over that a little bit earlier with international students and things, but it can be interesting. People from different places on Earth, we even have in our census data immigrant versus non-immigrant. So pretty cool. You can look at that stuff and kind of incorporate some of the anecdotal evidence that you have yourself from your market and say, okay, people, for whatever reason, don't necessarily like renting that much to this type of person, international students. I'm going to step in and benefit from that inefficiency, and I'm going to rent to them, and they're going to, pay me a really good rent. That's just an example of a strategy that you could use just using macro data. The other one on the census that I recommend is wage data. Canada has a great, and the United States has one as well, I'm sure. Just do a little bit of Googling, try and find wage statistics, and it's awesome. You can look up specific jobs, what the average wages are in even specific regions or provinces, and get a pretty good idea of what certain jobs pay. If you're looking at, let's say, professionals, and I am going to go quickly over this because it's pretty interesting and pretty cool. So let's say you want to invest in this market and you say, I want to rent to professionals in that market. You want to find out, can professionals actually afford the rents that you're justifying based on your renovations and things like that? First, you go to places like Indeed. You look at job postings for professionals. Are they going to be paying the wages for those jobs? And again, those are rosy, posts. The employers are going to try and negotiate those down, by the way. But you're going to look at those wages on places like Indeed and Job Search, and you're going to say, okay, this is what a professional is, roughly what the going rate is. And then you're going to hop over to the wage statistics, the wage data, or the census, and you're going to say, okay, the average wage in this region for a professional is this, meaning about a third of their income can go to rent. That would be this number. So that's a number, that, like a real concrete number that you can move with and work with going forward. If you know how much it's going to cost to do the reno, you know what the price of acquisition of that kind of property is going to be, you now have a pretty good plan set up, a pretty good framework, a pretty good, skeleton framework of your investment plan. And this all breaks down from real data rather than just kind of guessing, luxury apartments can rent for about $3,000 a month. And while that might be true, you might have found other listings for rental apartments at $3,000 a month. Are there professionals that are, trying to rent apartments for those rents? You can find that by looking up the wage data. Industry breakdown is another really important one. I know I talked about Sudbury a lot in this video, but Sudbury has industries that are growing and has industries that are growing on a global scale. So precious metals, really, really cool industry that I'm really interested in, and I like investing in Sudbury because of that. It's not the only reason, but these macroeconomic factors, feed into my investment plan. Again, if I could predict the exact price of commodities, things like this, or the price of nickel, I would just invest in futures. But I can't predict necessarily the price of them, but I can predict that the overall global demand for these commodities will go up. And that means the Sudbury market will do well because more labor will have to come in. More people coming in means house prices go up. Housing prices going up also means that rents typically will be going up because the two move in lockstep. So hopefully this was interesting for you guys. I know it was a longer one. If you do have any questions, reach out. I'm going to put a link in the description below where you can reach me by email and other things. It'll actually go through the office, but that's mostly just to do with spam and things like that. So if you do want to get in touch with me, that's how you do it. Just to recap, I'm a real estate investor, real estate agent who helps other investors in the Sudbury market. And if you have any questions at all, that's how you get in touch with me. It's been fun talking about macroeconomic data. Might do might make this part of a series and talk more about related things. But that's pretty much going to wrap up today's video. And I'll see you guys in the next one. Bye.